Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on this very exciting day at this very exciting time where we are expecting to hear from the Fed in momentarily. And I'm joined by Michael Oliver, a brilliant technical analyst and financial analyst of Momentum Structural Analysis. Michael, welcome on in here. Great to see you again, my friend.
Good to be back on the show.
Yeah, I think the last time it was an old show I used to do. So this might be your first time on Arcadia Economics. And what an exciting moment. I mean, if you need to take a break and, if you're flummoxed, there's a shocking headline. The Fed did not raise rates today. I think you forecast that too. So anyway, we have the announcement out. I can scroll down, but why don't you guide people through what you're thinking as we see the Fed announcement hit the tape now?
Well, there's a big focus right now on the T-bond market, T-bond futures, T-notes, TLT, et cetera. As they decline in price, yields go up. And while long-term, we think that the rates will go higher because inflation is definitely emerging, and it's not going to go away. Right now, technically, our work suggests that don't be short the T-bonds. At this point, I think that there's a very good chance over the next several months, starting soon, possibly from the low we saw today, the T-bonds, T-notes will rally sharply. And this likely will be coincident with the gold rally. Now, it's not that there's a linkage in that same way throughout history. We know that's not the case. And in the late 1970s, for example, T-bonds collapsed, gold went up big, and interest rates went up big, and inflation went up big. So that linkage that's been underway between gold and T-bonds over the last year or so, especially, is likely due to large investors who see an alternative to the stock market as being those two markets. No. So our work on the stock market right now suggests that yet another downturn is probably right. We're looking at the top. Now, I don't look for a crash. We forecasted a crash back in late 2019 when the market turned down in February. It triggered all of our numbers. We said, okay, we're going to crash. And in fact, we got to 35% norm, which is a crash. But it didn't lead to a bear market. In other words, we turned back up. And in fact, throughout history, that's been the case. There's only one time in history we've had a stock market crash that was followed by a bear market. That was 1929. And it even had a 50% rally back to the highs before it went into a protracted bear. But all our other crashes, like 1987 or the one we just saw last March, turned around again. I think we could top now in a softer way, but I also think at that time you're going to have enough smart money that is skeptical of the stock market. And I don't want to pen too many names, but Ray Dalio might be one of them. He's expressed some doubts about the reality of stock prices today, meaning that they're heavily distorted by monetary policy. And if the stock was $30 a year ago and says 30 now, it ain't unchanged, okay? Because the monetary unit has degraded so much. And I don't mean dollar versus euro, but in general, the quantity of dollars. So, but anyway, at that point in time, if we do roll over again in stocks, and I think you'll see T-bonds turn up as an alternative again to investors. And after all, they get a little more yield this time, right? Okay. And I think they'll plow back into gold at the same time. So if you're in the gold market and the silver market looking for the upturn, the renewed upturn, I'd be looking at T-bonds. And I think you'll see evidence of that over, especially next month. But anyway, that's, I don't know whether what they say today will affect that or not. It doesn't really matter, I don't think. I think that the events are underway, period, and they're not going to change much.
Yeah, I couldn't agree more there, Michael. And a quick look, it seems like gold and silver have spiked up so far. There is the gold chart getting back to positive territory. Now silver up 27 cents on the day. Michael, before we get into what I mentioned in reference in the headline of whether there's a reset coming, I was watching your last interview with Bill Powers last night. again, we see, I think this is what the CFTC defined as spoofing, but I know, and because you look at the technicals, so I'm curious, what do you make of when you see these V shapes, and we see it a lot in the metals? How do you account for that? How do you read through some of the things where we know bankers do what bankers do? How do you factor that into actually having your plan though?
Well, we don't. Okay. In other words, sometimes the short-term events are to be ignored. And after all, we're dealing with massive flows of money in all these markets. And most people tend to notice the drops that occur in the precious metals and point to it and say, see, I told you it was the top. Okay. I think it's just a lot of emotion. And I think you have to tend to look at longer term factors. And our longer term assessment of gold and silver is very bullish, and it's freshly so. Especially when you look at long term trends in gold and so forth. They don't last for a year or so and then fail. We just broke through, annual momentum of gold actually turned up in February 2016. We got bullish at a price of $1,140, which is $90 off the bear low. And we added in late 2018 to our bullish view. And then price broke out. And if you look at a gold chart going back several years, you'll see this big basing action where gold labored with all of its highs being about 1350 to the upper 1300s. It couldn't get through there. Multiple rallies failed there. And in 2019, it finally punched through. Silver did the same thing in July of last year. Now, these are fresh, massive base breakouts. We're talking bases that go back years, 5 and 6 years of basing action. You don't punch through something like that and then say, oh, it's all over, I'm going back down again. This is a huge base for gold, a huge base for silver. And we think the bull trend is likely to extend for a couple more years at least, and probably extend in a way that is not normal. Meaning, don't look back at the 2009, 10, and 11 bull trend. Don't look at the rally from 1976 low in gold to the 1980 high. I think we're looking for something a little more chaos theory, a little more accelerated, because I think the events in other markets, and I'm speaking macro technicals and the fundamentals, of course, are such that this could be different this time in terms of the violence of the upside in gold and silver. So that's what I'd be looking for. And I know a lot of people have been shaken out of gold since August, but I think it was a false shakeout, meaning it was a correction only. It was not really a bear trend beginning. And I think that the return to the upside is not likely to be slow and plodding. I have a suspicion that we're going to get something out of gold like what we saw last July. We had a buy signal number for silver at $19.48, which when you looked at a price chart last summer, well, you'd already been up there before. What's the big deal? You'd been up to 21 or so a few years prior to that. You'd been up to the upper 19s 6-9 months prior to that. But 1948, when we hit that price last July, it took annual momentum through a massive triple top breakout at a very shallow level, meaning it wasn't overbought when it broke out. And silver went up 50% in 3 weeks. That's the kind of chaos theory I'm talking about. So if gold is going to resume the bull trend, which I think it will, I suspect there'll be a point it will be so sudden that those who abandon ship won't get back on properly or won't get back in at all, in which case they'll be cussing themselves going forward. But watch the T-bonds too, because I think they'll help give a clue in that regard.
Yeah, it makes a lot of sense what you're saying there, because we can see the spike in 1980, which I'll like to come back to, because as I've been reading a book about what the CFTC and COMEX actually did then, I mean, it seems like they went pretty far out of their way to cap the price, change the rules, make sure that they raise margin high enough. So actually, let's start there, Michael. Do you think that silver was heading higher than $50 in 1980?
No, probably not. I think that the events you're talking about, which by the way, were the chairman of the COMEX was David Johnston. I joined E.F. Hutton in 1975. I left graduate school of political philosophy and joined the gold market, which was legalized in 75. And I got hired by E.F. Hutton's headquarters in New York, commodity division. And the head of that department was David Johnston. He was also chairman of the COMEX. Now, during that, I wasn't with Hutton at that time in 1980 at the peak of that bull market, but I do recall that Europeans were being killed on the short side. They were short the market. And the COMEX changed some rules and said, okay, no new, I think it was no new long positions or something.
Right.
And so I think it was ready to peak anyway. It was clearly in a blow off type behavior. And when markets do that, they tend to get done what they're going to get done pretty quickly. And so when it turned down, it really turned down, and it killed Bunker Hunt on the other side. You know, went down to $15 within, it was about a year or something like that. So, you know, swings both ways. But we're in a different world now. I think the inflation we're about to see, particularly the monetary degradation definition of inflation, not just what the cost of bread is, but the actual quantity of money units that are being, you know, produced here and elsewhere, is such that it doesn't even compare to what happened in the inflationary period of the late 1970s. I think it's far more accelerated, far more over the cliff, and therefore the response from gold and silver is likely to be far more dramatic than it was even then. And yes, we expect to see that dual highs at $50 area taken out. And we made a projection several months ago based on some long-term metrics that we were using. And to some extent, it was a forecast not as hard and fast as we normally make, but we thought we could see $200 silver in this bull trend, possibly in the next year or two. And at that point, see gold in the, you know, approaching 10,000 from the underside. Of course, silver at 200 would be a far bigger move than gold merely going from, you know, around the 2000 level up to, you know, another fourfold move up to upper, you know, anyway. So silver is the place to be. That wasn't true from 2011 through 2016, 17, and 18. Silver vastly underperformed gold. It collapsed more, didn't behave well on the upside like gold was. But last July, when it broke out through our annual momentum, so did its spread, measuring it versus gold. And we didn't just measure the spread as a spread chart, we also did momentum study of it. And it said, no, this is for real. Silver is now shifted to outperform status. And we think it will hold that status going forward. So watch gold, but be long silver.
Yeah, well, that's pretty much what I've done. So good news to hear. And I agree with everything you're saying, although just to go a little bit deeper into it, what leads you to believe that this time is different?
Well, look at the stock market, for example. Okay, it's been the chief beneficiary of central bank largesse. Okay, they started big time. Even Bernanke wrote a paper, I think it was in 2003, so before he became chairman of the Fed, basically intellectually defending the position that one of the focus points of the Fed isn't just interest rates, that kind of stuff, but to promote the stock market, to drive it higher. Because if you cause people to save less money, he said, they'll spend, and that's good for everybody. And he said it basically in those words. So he discouraged, he had a policy that when it went into effect, it didn't work during the 2008 drop. I mean, they were trying then to stop the drop, and it didn't work. So people should remember that. The Fed isn't always on the right side of the equation here. And finally, in 2009, when we collapsed to 667 points on the S&P from, I think it was a 15 to 70 high, finally investors said, okay, you've created this river flow of money. We're going to put it to work. And now it makes some sense to put it to work in the stock market. And we were major bullish at that time as well in March of 2009. In fact, the low week we announced the major turn was underway. We didn't know it would extend for a dozen years. So we've seen one of the longest printed bull markets in stock market history, particularly in the US market. Not so true in European markets where they sort of plateaued really since 2015. But in our market, it's just, you know, it's off the page. And we argue that our market is the greatest beneficiary of what we've seen monetary wise. But ultimately, that trend won't continue. Once you create a reality excess, as the central banks have done, investors will finally get suspicious. You know, again, the Ray Dalios of the world and other large hedge fund managers who realize the connectivity between that monetary policy and the stock market, and how it is not necessarily a reality that sustains. And the shift will begin. I think it's already begun to some extent, where we can measure like upturns in the Bloomberg Commodity Index or gold, or gold miners relative to the stock market. We can start to see that the money flow is being diverted by some investors into those categories. And we think that will become more and more obvious in the next months. And at that point, then the herd tends to follow. And smart money went first, and the herd follows. And that's when you get this accelerated phase in the gold and silver markets and a divestment from the stock market, because it's just high risk. It's not, it's not a low entry point. Commodities were a low entry point over the last year or two. I mean, they were smashed off the page. What are they going to do? Go to zero? Okay. So finally, when the river flow comes, designed to keep certain paper assets up, some investors divert the river flow in a different direction. And I think we're starting to see that.
Yeah, I think so. And I saw for a second the missus came and grabbed something off the shelf, wondering if she heard you talking about Bernanke and need to grab some silver coins just to feel safe knowing what he's doing. Because it's interesting you mentioned what he was writing about at Harvard. Maybe he was busy with that, which
gold
explains...
is an unusual asset. It's an asset that people hold as sort of disaster insurance. They want, they feel if things go really badly wrong. But let me just end by saying that nobody really understands gold prices, and I don't pretend to really understand them either.
So maybe that's why he doesn't understand it. Although, again, you look at the numbers. I'm pulling up Bitcoin here, which we're not going to get into what people think is the money or safe haven or all that. But just to point out here, back in July or in 2016, let's call it $500 it was floating around. So between 2016 and about 5-year period, from $500 to 56,000. So that's 120 bagger. And here we see silver currently about half of its 1980 high. So, I mean, you explained before some of the reasons why you think the numbers could get big, but what would you share to folks who might want to look at those two comparisons and where that leaves us?
When Bitcoin first came out in the futures markets, that is, in December of 2017, it was 20,000 plus. And we issued a technical report that argued for a collapse. And actually, it went down to 3,600 was its low. I'm talking Bitcoin futures now on the CME. And then after it made that low beyond what we thought, 5,000 would be a low area, at least a minimal target for the collapse. Because it was a bubble. We thought it was a bubble, and it technically was a bubble. It went to 3,600, and when it reemerged back over 5,000 a couple years ago, we turned bullish again. And frankly, nothing on long-term charts of Bitcoin since then has altered that assessment. And we have to be positive because it hasn't broken anything that we measure, and we don't look at the price charts primarily. We look at long-term momentum of price, which is a bit different from the price chart, what you see there. There are some danger levels for Bitcoin, but they're down right now around the low 40,000s where you could break some stuff. But our main concern about Bitcoin right now, and we hear this argument about, oh, it's replaced gold. The millennials now see it as the gold market. I mean, they don't want to buy gold. Only their granddad does. We projected before they opened their mouth that head of the IMF, Lagarde, ECB, and Yellen, the new Secretary of Treasury, would say something negative about Bitcoin. And the reason is that it's a threat if it became viable and widely used. Morgan Stanley today announced that they're going to offer it to some of their people. As it becomes more legitimized and used as a monetary unit, I don't know what percent of transactions would scare the central banks, but there's a point at which they're going to clamp down, or they're going to have their governments clamp down on Bitcoin and other cryptos. And the reason is that it threatens their control over monetary policy. Because if the money unit that people are beginning to use too much of, let's say, is not under their control, then they don't control monetary policy. And so they'll come up with, notions that it's illegal, it's a criminal act, it's people washing money, et cetera, et cetera. In fact, those are the words that were used by Lagarde and Yellen over the past month, words that implied criminal activity. Now, you don't make a statement like that against Bitcoin without having policy intent behind it. So I think that Bitcoin longs need to be prepared for the possibility that there's some kind of announcement of regulatory action. Now, I don't think they could ban it. I don't think that would work. But some sort of regulatory action, and that could generate a wave of downside in Bitcoin and possibly spook some of the Bitcoin longs into saying, well, you know, I'll go to gold, because they can't do that to gold and silver. It's in people's pockets. It's global. It's been there for thousands of years. Yes, Roosevelt did it. He got away with it for a while, but you can't do that anymore. So in effect, gold is beyond the regulatory control, but Bitcoin, that's an open question. And I suspect there's going to be regulations that we'll be hearing about in the coming month or two, especially as Bitcoin, you have headlines like this Morgan Stanley headline. That's got to spook the Yellens of the world in terms of their control over money.
That's what I was just wondering, because she can't be happy her buddy Jerome Powell's getting pushed off center stage here. Now he's just like the opening act, and you have Morgan Stanley. And Michael, is someone who left Wall Street because I started seeing how distorted these headlines were. This is complete speculation, we'll call it, but as someone who's also studied psychology and subliminals, interesting the imagery you have here. First, wow, I can use Bitcoin on my phone, Bitcoin US dollars. So it just looks like you're doing a currency swap on Robinhood. Look how easy it is. There's Morgan Stanley. So you're getting some criminal banks involved to offer it to their clients. And Michael, we don't even have to wait a couple of months for you to be right. I don't know if you saw in the smaller print here, tax surprise looms for NFT investors who use crypto. So at least my initial reaction, which is not to say this is correct, is that, gee, if I were, now I wouldn't want to do this, but if I were a banker who was willing to railroad people, this reminds me a lot of what we see where the metals, they let it get built up and then drop the hammer. I don't know what that tax surprise looming is, but certainly just interesting to see him Bitcoin taking center stage over the Fed. Meanwhile, there's the silver chart. Here's gold, looks healthy.
It's a new high for the week. Yeah.
And with the yield, it looks like people are selling at least so far today, they're selling their bonds and buying gold and silver.
Well, I think that, we still think that, again, this is a technical, long-term technical view, that there's one more surge in the T-bonds, one more drop in yields. It may not get back to the levels we saw back, last year, but something sharp. And I think it's largely going to be a function of simply money saying, I'm going to lighten up my stock position. I'm going to go into these alternative assets where I feel a little safer. And I think that will be the causal factor primarily of T-bonds having a scoot on the upside here. But it looks like gold might be leading that.
Yeah. And Michael, perhaps the last one I have for you today before we wrap up. I know you probably have a lot going on and your clients wondering what to read through this, but obviously the timing is the tricky part. But is there anything that you're able to extrapolate, or maybe if not the timing, but hey, when X happens or when we break this level, any markers or harbingers for people to look out for?
Well, I think there's one prevailing view out there that I think is misplaced, and that is among gold mining investors, which by the way, we measure gold versus gold miners, and our assessment is that in the correction we've had since August, that the gold miners have now turned on a relative performance basis back into outperformed status versus gold. So it's now time to, again, emphasize ownership of miners as opposed to gold. Gold pulled back less during the last 8 months than did the miners, but we think that's going to flip. But I think that the stock market is probably a key here, because most people they've given up any bearish notions they had. They've simply been driven off the page by the action. They're intimidated by it. And so you don't have that many skeptics out there that you used to have. Therefore, it's more vulnerable, probably, because it has fewer skeptics. They think the Fed has the back of the market. If that market turns down again, that asset category, what is the Fed's response going to be? You could take all your economic numbers of recovery that you think might be going on, which we're skeptical of, even if you start to see them. And they're going to want to defend that stock market. And so they're going to do everything they can monetary wise. That's going to be a new factor that drives their monetary policy to the point where they'll ignore the inflation indications from the price of soybeans and copper, et cetera, because that stock market gets vulnerable. They're going to defend it. And if they defend it, they're going to create more river flow. But the investors are going to divert that river flow elsewhere, is our view. And it's primarily going to be the gold and silver category in the long term. So that's what I'd be looking for if I were a gold mining investor, for example. I'd be looking for that stock market downturn. Now, again, the one assumption is among the gold mining investors is, gee, if stocks go down, we'll go down too, because they remember the 6 days in March, which is really what it was amounted to. It was 6 days last March where all of a sudden the gold miners collapsed with the stock market. But what people fail to realize is prior to that collapse, if you look like at GDX, for example, the gold mining ETF, it had a year and a half of upside, and not downside, but a year and a half of upside before it dropped sharply from that March high to that March low in 6 days. And therefore it looked like it was replicating the stock market. We argue that that one example is not a good example to use, because right now we've been going down for 8 months in the gold mining stocks while the stock market's been going up. So they're inverse now. Treat them that way. That's our suggestion.
Yeah, I think that's some great advice you laid out there, Michael. And perhaps just in wrapping up, can you let folks know where they can find you on the web and how they can get access to the services that you offer if they'd like some more guidance?
Sure. Well, we've got some information about the firm, examples of our methodology, which is distinctly not orthodox technical analysis. We've invented our own momentum-based structural analysis of market action. We examine all 4 asset categories in our major report. That'd be the stock markets, foreign exchange, and commodities. And we're constantly assessing them together because they should be assessed together. You should not have a narrow focus and look only at gold. But our website is www.olivermsa for momentum structural analysis, olivermsa.com.
Well, I appreciate that, Michael. Thanks again for making some time on this exciting day. I've been looking forward to getting you back on here, and perhaps the next time you're back, we'll see what silver price is then. Who knows? Maybe today could end up being the turning point, but in either case, I appreciate you being a good voice
Well, let's go get a beer and watch Powell.
I am down. In fact, I guess the press conference is starting soon, so
good.
Maybe that will jack the silver price even a bit higher, and will be fun to follow along.
Thanks, Chris.
And we